Good Friday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the disclaimer. Be aware that Market Chameleon, myself, or Dimitri are not registered investment advisors or a broker-dealer. If you need professional investment advice, please seek out a registered and licensed broker-dealer. Take one more look at the disclaimer. One more look at the disclaimer. And there he is. Last look at the disclaimer. Thanks again for joining, everyone. And here he is, Dimitri Parkamanek. How you doing, D?
Good morning, Will. And good morning, everyone. Thank you for joining. I am going to share my screen. And I want to just give a quick note to anyone joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's keeping an eye on it, and he'll let me know and read them back to me. And to give you guys a couple minutes to type in those questions, we're going to take a look at our pre-market report to see if we could get insights on what's going on in the pre-market hours, and then we'll move on to the questions. So pre-market report here. Up top, we have this calendar view, and this summarizes the activity from a high level, what happened in the pre-market hours. And you could see that for the last week, we show that data as a way for you to be able to compare today's activity with what has been happening in the most recent days. Also, you could just kind of quickly scan it with your eyes to see if you see a particular trend or something unusual. Today, we are on April 5th, and so far we have 504 stocks trading higher in the pre-market, 307 stocks trading lower. We have 126 million shares trading on up volume, 74 million shares trading on down volume. And if we convert that volume to dollar value, we have $5.8 billion worth of stock trading higher, $9.37 million worth of stock trading lower. So looking at that so far, trading in a pre-market looks like, it has a bullish bias or bullish lean. Let's look at it from a couple more perspectives, then we'll move on to our questions. So I'm going to scroll down here, and now we have this granular view of what's going on in pre-market. We see stock symbols with price changes and volume alerts, and we have our most active stocks in the pre-market, a list of our biggest gainers, and a list of our biggest decliners. And here I see 60 stocks made our biggest percentage gainers list, 41 made it on our biggest percentage decliners list. So from this perspective, also points to a slightly more bullish bias in pre-market trading. Now, to make it onto this list, we do set thresholds, because trading in a pre-market could be with very low volume, very low liquidity. So if it meets our thresholds, it can make it onto this list, but that does include small cap stocks. You see the market caps over here in this column. It could be an ETF. It could be an inverse ETF. It could be a closed-end fund. So to narrow down to a smaller group of stocks, we could use the filters above. As a reminder, if you guys created a watch list and you want to filter this report or many of our other reports by your watch list, the group of stocks that you're focused on, you can do that. We're going to use this filter in ETF in our example. When I click on it, you see a drop-down menu to select from. We're going to choose SPY, and these are different ETFs that you could select. And by selecting SPY, we filtered the list below by stocks that are holdings in the SPY ETF. So what we did was narrow down our report to stocks that are in the S&P 500, right? That's what we did. And 7 stocks made it onto our biggest percentage gainers list. And we got 1 on our biggest decliners list. And that also indicates a slightly more favorable or bullish bias in that pre-market trading. And we looked at it from a couple different perspectives, and so far they all point in the same direction. So we gave it a couple minutes, Will. Now, I'll take some questions if you have them.
Yeah, we don't have any questions popping up from this morning, but yesterday Rob left us with, he's asked, is there a chart for tracking straddles over a longer term, like 2 weeks or a month? I don't know if that's something you can look at.
Right. Okay. So there are a couple things we could do with that. Now, there is a report here. Let's come up here. I believe it's under options, straddle, and wing back tests. So I'm going to click on this. And what this report does is it tracks a straddle over a 1 week period. Okay, so it says, okay, well, starting on Monday, if we looked at the nearest term expiration that covers an entire week. Okay, so as long as they won't look at a 0 DTE because obviously it doesn't go for an entire week. But once it finds the nearest term expiration that covers the entire week, but it could be a monthly, it looks at that straddle on Monday at 10:30, and it takes a record of it, a snapshot record of it, and says, okay, what was it at 10 a.m. on Monday? So we give it a half hour because in the morning, things are wider and in trading. So we kind of gave it a 10 a.m. Standardized snapshot. 9:30, sometimes stocks don't open or they open very wide so we gave it 10 a.m. Then what it does is say, okay, from 10 a.m. on Monday, we took that first picture of what was the premium, what was the straddle price, and then we looked at it on Friday at the end of the day, and we compared that performance. Right, that's what this report is doing, and then it's doing that week over week over week to see how that straddle performs week over week over week. Right, so this is week by week at the money straddle. Right, that's what this is. We also do that with the wings, 25 delta call, 25 delta put. But since the question is on a straddle, we're going to focus on the straddle, at the money straddle. Okay. So now that we defined, the time period that we're tracking, right? We could go back 12 weeks. We could go back longer, 26 weeks. Here's 12 weeks of data. And what this will do then, you can see here 12 weeks of data here. Okay, and then we track it 3 different methods. We talked about this yesterday. One is if you just did the straddle and on Monday you forgot about it until Friday. You did nothing. All you wanted to do was, see how it performed from that Monday to Friday. And then we talked about, well, straddle is not always perfectly delta neutral at the onset, because if if the stock price is not exactly at the strike price, that means that one of the options is in the money. The call could be in the money or the put could be in the money, because we find the strike that's closest to the stock price. Well, that will mean that that initial straddle has some kind of directional bias. The idea of a straddle is it doesn't have a directional bias. You're buying the premium based on what you think the stock will move from this current price to the end of the period, right? So if you buy a straddle and you buy the call and you buy the put for a premium of, like, say, 1% above spot, well, if you bought it, you need the stock to move by more than 1% to cover the cost of both options, right? Because one option will, if it moves up really high, then the put will expire worthless. The call will be in the money. If it moves down, the put will be in the money. The call will. So it has to move enough to cover the cost of both options for it to be profitable. So one of those legs has to be in the money by enough. But what happens is that if one of the options is in the money, let's say the call is in the money. Let's say the stock, you're doing $100 straddle, and the stock is 101. Well, that means the call is more in the money, right? If you're doing it, that means you have already a directional bias. You want it to go up, right? Now, it does matter to you which way it goes, because to go down, it has to go down a further distance to cover all the entire straddle, right? So you want it to go up. So how do you offset that initial delta? Is by hedging it, by hedging the delta using the stock. So that's yeah.
Could you just walk through the click process to get this from Microsoft again?
So using the above menu options, right? I went to the right under tools. It says straddle and wing back test right here.
All right. Awesome.
Yeah. So now I'm looking at this. So now I have an unhedged straddle, just wherever it is, right? I'm taking the strike closest to where the stock is, and I'm just buying the call and buying the put. That's this strategy. But what if I wanted to compare it to a delta neutral? Because there's going to be some bias by doing that. So to remove that initial directional bias, we're going to hedge it off with some delta. So that's called delta neutral. So now I have two different strategies to compare, right? So I could now compare even, how they perform versus each other. And then I got another strategy. Well, sometimes you buy the straddle, and a lot of traders, a lot of professional traders, they're buying it because they believe the implied volatility is too low and that the realized volatility will be higher. And if you're selling it, you think the implied volatility is too high and the realized volatility will be lower. Well, to trade the implied volatility versus realized, you're going to be using the Black-Scholes model. You're going to be using your delta, your gamma, right? You're going to use those Greeks to manage your position, to manage your risk and hedge your deltas. And now there's no one right way to hedge your delta. Sometimes you could hedge your delta just based on the stock moves, you have a new delta that met your thresholds. Let's say 500 deltas, you hedge it. 1,000 deltas, you hedge it. Or you could hedge it periodically. So what we did was we used end of day. Okay, so if I had to, why do we used end of day? Because if there was any kind of maybe standardized way of looking at it, would be end of day, because end of day is kind of like that's where you want to go out flat, right? If you want to go out flat, you probably want to do it end of day. So we used end of day rehedging. In other words, the stock starts out today, you have a gamma, it's moving around all day. Right near the end of the day, you have a new delta, we hedge that, right? And we do that every day. So that's trading the Black-Scholes model. That's trading the implied volatility versus realized. Now we have these three different ways of looking at it, and we could compare which one was better, right? What was better if we did the straddle, and were they profitable? And remember, if one side is unprofitable, the other side would have been profitable, right? You could do either one. You could be on the long side, or you could be in the short side. And we're looking at it from the long side right now, right? The short side would have been reversed, but we're doing it all from the long side. It's just it's easier to pick that side. So here's a Microsoft. This is ordered in by market cap up here. Okay. So the first three are Microsoft, then you see Apple 3, Nvidia 3, and then we could filter these out if we wanted to remove a hedging. But let's just take a look at those three. So here in Microsoft, right? Let's just isolate Microsoft and makes it easier to look at. So I clicked Microsoft, right, in the search to remove all the other ones for now. And what do we see here is that now we have these three different trading methods for at the money straddle. And we're looking at 12 weeks of data, 12 observations, right? That's what we have set here. We could go 26 weeks, we could go one. Let's leave it at 12 for now. And these were the different outcomes. So we see that just taking the straddle in Microsoft, week after week after week, we know there's going to be losses, there's going to be gains, right? We're looking at the averages. What happened? Did the markets tend to underestimate the straddle? Did they overestimate the straddle? By how much? Like, what's going on? So here it says that from the long side, 67% of the time, the straddle was worth more at the end of the week than it was at the beginning of the week, right? So from Monday at 10 a.m. to Friday end of day, 67% of the time it was worth more. Well, how much more on average, right? Was it 0.5%, 1%? Was it 100%? How much more was it worth more on average? On average, it was worth more by 18%. Okay. So every $1,000 in the straddle that you bought was worth $1,180 by the end of the week. That's the historical data. Okay. This is what it's saying on average. But what about the median, right? Because we have 12 observations here. If we had, many small ones and one big one, 100% straddle would pull up the average. So what was the median return right in the middle? Was it positive, negative, by how much? Well, this shows that the median return was 11%. So it looks like, that maybe there's a slight skew because of a big, but the median and the average return are close. Okay, so there's not a huge skew, meaning there's like one big outlier, out there. That's not what it looks like, but we could open up the data and look at it. Okay, we'll do that afterwards. So then what do we want to know about the straddle? Okay, we see what it tended to do. We see the average returns, but how much variability is around this return? Okay, is it, does it fluctuate between up 20%, down 15%? Well, like, what is the variability here? Because that makes a big difference too. You're getting into a strategy that is very volatile. What if you're down 100% one week and up 118% the other week, or how much variability is there in these returns? So that's the standard deviation of the return. So you could see it's huge, 71%. There's a huge variability. We're talking about options. They have a lot of variability, right? Because an option could go in 1 week to being worthless, completely worthless, 100% loss. or it could go to, double or triple or whatever. So this is saying, like, this is showing us how much variability there is in this strat. We could even compare them. Like, I'm going to uncheck this. So you could see that here's Microsoft, here's Apple. So Apple's aren't as much variability. NVIDIA. So NVIDIA and Microsoft are similar. Google, the standard deviation is lower. So this is what we're talking about. Okay. Let's go back to Microsoft. So now we got that. So then what do we want to do, right? Okay, you got 12 different observations. What else do you want to look at? Well, what is the worst one? And what was the best one out of those 12? Well, the worst return was down 80%, which means that if you bought a straddle for $1,000, at the end of the week, you get 200 back. You lost 800. That was in the last 12 observations. That was the worst one. What about the best one? Well, the best one was 189%, right, from the long side. So that gives you could see the range. You could see, like, well, you got to be aware, like, you're trading these straddles. If that's what you're looking at, you got to be comfortable with that. You got to be aware of it. That's why we look at, potential returns and potential risks. You got to weigh both of those. And then we got this Sharpe ratio here, which is, we made it very simple, and we just took the average return and divided by the standard deviations of the returns, right? So this kind of is a quick way to get in a sense of, well, how much return am I getting for the variability, for the risk? So you want this number high, right? Because if your return is high and your variability is low, this number is going to be high, and that's what you want. You want higher return, lower risk. Okay. Now, all right, so now we looked at the first line. Well, let's compare it to the other one. Well, maybe that wasn't the best way to trade that straddle. Let's compare it to the other way. So what if this was due to, because there's some bias there, a delta bias, and we got lucky. Let's say we got lucky because we had an initial delta that was positive and the stock went in our favor. So that skews it a little bit, right? That does skew it a little bit. So what if we hedged the delta neutral? We need to compare that. And here it's saying, okay, on a delta neutral basis, it was a winner 58% of the time. Okay, so it does look like we got lucky there a little bit on the first one, probably because, we had some delta that went our way. So, but it's still showing up as a positive. So not 67%, 58% of the time it was positive, but positive by how much, right? And I'm sorry, 58% of the time it's positive, but we don't know if overall the average return was positive. That just means 58% of the time it was more profitable. It was profitable. Okay. But if 42% of the time, if it was unprofitable by a bigger percentage, you could still end up with a negative return. Okay. You could have this more than 50%, this negative. Think of it as like you're playing a game where, you have 10 numbers on the wheel. And, if one to 9, pays you $1, and number 10, you lose, $1 million. It's a negative, right? Negative expected value, negative return, even though you have more chances of winning. So how much was it? So this one's 17%. So the return actually is very close. Okay, so that was very close. And the median return is actually higher. So even though here we had less frequency of wins, right? less frequency, more than 50%, but less, not 67%, 58% less frequency of wins, but the average returns were very similar, and the median returns were actually higher. And on top of that, the standard deviation of the returns dropped a little bit. So that's something to consider. When you're looking at that, maybe the delta neutral is a better way to go, and you're achieving similar returns. And here's the chart, right? So very similar. Well, what if we didn't hold the straddle the entire time? We rehedged it, like we said, like we traded the Black-Scholes model, we traded our gamma, and we locked in realized volatility versus the implied volatility. Well, now we got down to 50-50, but on average from the long side, it was a loss, minus 2%. Median return was up 1%, which means that the implied volatility, just looking at that, the implied volatility was priced fairly well, right? The implied volatility, if we just consider that, if we use daily closes as the realized vol, that the implied volatility from the start of the week was pretty good at forecasting the volatility going forward in Microsoft. It was like right at break even here. Standard deviation was 38%, so the standard deviation fell, because now you were rehedging it, you had less variability. Your max loss was down 78%, max gain up 69%. But Sharpe ratio was negative because you had a negative average return. So these are things to consider. These are things when you're looking at the straddle and you're trying to figure things out, and you want to know, what are the potential returns, potential risks, what were the tendencies, how was the market historically at pricing future volatility. Like now you get these more informed decisions, before you're going in. And then we could start looking at them. We could open it up and start looking at the data. We're actually running out of time, but maybe we could keep going next week, and then we could see the actual raw snapshots and how we got there. Okay.
That was awesome, Dave. Thank you. Rob was very appreciative. Thank Evan for putting in the average option volume into the 52-week high low. Mike McCrae is wonderfully happy about that. Awesome job.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great weekend. Reminder, Tuesday, we're having a webinar with Interactive Brokers. We will be talking about contingent stock trades, which will also reveal a new feature on the multi-leg trades. And we're going to talk about the significance of those stock contingent trades, why you would want to use a stock contingent trade, how are other people using stock contingent trades, and what type of risk exposure can you narrow down and target. So I think it'll be very interesting. If you guys want to see it live or a replay, register with Interactive Brokers, and it will be because we're not doing it on YouTube like usual. This is hosted by Interactive Brokers.
Yeah, so I'll put that link in the YouTube chat right now. Great job, D. Have a great weekend, everybody. Thanks
Thanks, everyone. Stay safe out there.